The Federal Reserve Bank currently maintains a balance sheet exceeding $7 trillion despite multiple attempts at quantitative tightening. This massive ocean of liquidity functions as a high-pressure weather system capable of generating sudden and violent financial hurricanes. Financial analysts observe that the silver market has recently experienced a systemic price collapse that appears detached from physical demand. The chief analyst identifies the primary driver of this volatility as the concentrated short positions held by J.P. Morgan and other bullion banks. Institutional trading desks utilize high-frequency spoofing and automated sell orders to overwhelm the buy side of the paper exchange. This strategic dump of paper contracts acts as a psychological warfare tactic designed to trigger a retail panic. When the price of silver drops 10% in a single trading session, it is often the result of a coordinated institutional heist. J.P. Morgan has historically paid hundreds of millions of dollars in fines for the manipulation of the precious metals markets. The analyst notes that these fines are often viewed by the banking sector as a mere cost of doing business. The current market crash is being engineered to facilitate a massive buyback of underwater short positions. By driving the price down to the $78 level, the institutions can exit their losing bets at a significant profit. The chief analyst observes that the paper price is a digital illusion that does not reflect the actual scarcity of physical silver. The United States Mint and other global refineries are reporting record high premiums for physical coins and bars. This bifurcation between the paper price and the physical price is the hallmark of a fraudulent market structure. Wall Street wants the public to believe that silver is an obsolete asset that no longer holds value in a digital economy. However, the underlying industrial demand for silver in the green energy and artificial intelligence sectors is expanding. The analyst highlights that silver is an essential component for every semiconductor and high-efficiency solar panel produced today. The $500 billion Project Stargate initiative requires more silver than the global mining sector can currently provide. The chief analyst suggests that J.P. Morgan is well aware of this impending industrial supply squeeze. They are crashing the market today to secure as much physical metal as possible before the true price discovery begins. The $85 resistance level was a critical psychological barrier that the institutions needed to break. By forcing the price below this level, they have triggered a wave of automated stop-loss orders from retail traders. This forced selling creates a feedback loop that the institutions use to scoop up cheap metal on the secondary market. The analyst explains that the silver market is the most manipulated commodity market in the history of finance. The amount of paper silver traded on the COMEX exchange exceeds the annual mine production by a factor of 100. This fractional reserve system is vulnerable to a bank run, where holders demand physical delivery of their metal. The chief analyst identifies the current price drop as a preemptive strike to prevent such a delivery crisis. By scaring investors out of their positions, the banks reduce the total number of outstanding claims on their vaults. The analyst warns that watching the market before Friday is critical because the option's expiration cycle is nearing completion. Institutional players often target specific price points during expiration week to maximize their profits on derivative contracts. The $90 and $100 strike prices were heavily defended by the short sellers throughout the month. The chief analyst maintains that the current crash is a temporary deviation from the long-term bullish trend. Historical data shows that every major silver bull market is preceded by a violent and sudden shakeout of weak hands. The 1980 and 2011 rallies both saw similar institutional manipulation before the price went parabolic. The analyst suggests that the $78 level will likely serve as the new institutional floor for the next move. Smart money investors are using this dip to increase their holdings of physical bullion and mining stocks. The chief analyst observes that the gold to silver ratio remains at a level that signals extreme undervaluation for silver. While gold is trading at record highs, silver remains 50% below its inflation-adjusted peak from 40 years ago. This discrepancy is being maintained through the strategic use of paper leverage and institutional shorting. The analyst highlights that the cost of production for silver miners is rising due to higher energy and labor costs. A silver price below $80 is not sustainable for the long-term health of the global mining industry. The chief analyst concludes that the silver fraud is a calculated attempt to redistribute wealth from the public to the banks. J.P. Morgan is not crashing the market because they are bearish on silver, but because they want to own more of it. The data on institutional trade flows shows a massive increase in physical acquisition during these price drops. The analyst will continue to monitor the delivery notices and the vault inventory levels for signs of a reversal. The truth about silver will eventually be revealed when the paper exchange can no longer satisfy the physical demand. Until then, the market remains a battlefield where the informed investor must look past the digital noise. The silver crash is the ultimate trap for the unprepared and the ultimate opportunity for the insightful. The chief analyst maintains that the coming months will see a historic revaluation of all hard assets. Silver is the leading edge of this transition because it is the most critical and the most suppressed. The second phase of the institutional manipulation involves the weaponization of the futures market delivery mechanism. The chief analyst observes that the COMEX exchange was designed to facilitate hedging for producers and consumers of metals. However, it has been transformed into a casino where big banks can print unlimited paper silver to suppress the price. When a major institution like JP Morgan enters a massive short position, they are effectively selling silver they do not possess. This creates a synthetic supply that offsets the natural demand from industrial users and private investors. The analyst notes that the SEC and the CFTC have historically turned a blind eye to these concentrated positions. The current market crash is a clear example of how concentrated selling can overwhelm the price discovery process. The chief analyst explains that the banks use a technique called layering to create a false impression of market sentiment. Layering involves placing large sell orders just above the current price to prevent any upward momentum. Once the price begins to drop, these orders are canceled and the banks buy back their shorts at the bottom. The analyst identifies this practice as a core component of the silver fraud that has persisted for decades. The $80 level was a major support zone that had been defended by retail buyers for several weeks. By smashing through this support, the banks have created a technical breakdown that looks bearish on a chart. But the chief analyst recognizes that this is a manufactured breakdown rather than a fundamental shift. The demand for physical silver from the solar industry alone is projected to consume 20% of mine supply. Project Stargate and other AI infrastructure projects will add another 50 million ounces of annual demand. The analyst highlights that the global silver deficit is currently at its highest level in 30 years. There is simply not enough physical silver being mined to satisfy the growing technological and monetary needs. The chief analyst suggests that the banks are crashing the price to discourage new mining investment. By keeping the price low, they prevent new mines from coming online, which keeps the supply tight for their own future use. This is a long-term strategic game where the banks seek to control the entire supply chain of critical materials. The analyst notes that JP Morgan has accumulated one of the largest private stockpiles of physical silver in history. Reports indicate that their vaults hold over 100 million ounces of high-purity bullion. The chief analyst asks why a bank would hold such a massive amount of metal while simultaneously shorting the market. The answer is that the short positions are a tool to keep the price low while they continue to accumulate. This is the definition of a double game, where the public is being told to sell while the insiders are buying. The analyst warns that the volatility before Friday will likely be used to wash out the remaining leveraged long positions. Trading desks will target the margin call levels of retail traders to force even more selling. The chief analyst maintains that the structural integrity of the paper market is reaching a breaking point. As more investors demand physical delivery, the banks are finding it harder to find the metal to satisfy the claims. The analyst points out that the registered inventory at the COMEX has dropped by 50% in the last year. This drain of physical liquidity is the primary threat to the institutional short sellers. The current crash is a desperate attempt to reset the market and replenish the vaults with cheap metal. The chief analyst observes that the silver miners are being unfairly punished by this institutional manipulation. Stock prices for major silver producers have dropped 30% despite having strong balance sheets and low debt. The analyst suggests that this creates a secondary opportunity for investors to acquire mining shares at a discount. Historical performance shows that mining stocks often lead the metal during the recovery phase of a cycle. The chief analyst concludes that the silver fraud is a systemic issue that requires a move toward physical ownership. By holding the metal in your direct possession, you remove it from the institutional lending and shorting pool. This is the only way for the retail investor to opt out of the rigged game played by Wall Street. The data on silver coin premiums shows that the public is already starting to understand this reality. The analyst will continue to track the movement of silver from the exchanges into private vaults. The silver crash is a warning that the old financial system is willing to use any means to maintain control, but the laws of supply and demand cannot be suspended indefinitely by a paper contract. The chief analyst maintains that the truth of silver scarcity will eventually override the institutional fraud. The current price drop is the last gasp of a dying manipulation strategy. The final part of the silver fraud analysis focuses on the broader macroeconomic consequences of the market crash. The chief analyst observes that the manipulation of precious metals is part of a larger strategy to support the fiat currency. If the price of silver and gold were allowed to rise to their natural levels, it would signal a loss of confidence in the dollar. The banks and the central banks work in tandem to ensure that hard assets do not overshadow the government debt. However, the chief analyst recognizes that the current level of global debt makes this suppression nearly impossible. The interest payments on the United States national debt have surpassed $1 trillion per year. This fiscal reality ensures that the dollar will continue to lose purchasing power over the long term. The analyst notes that silver is the ultimate hedge against this systemic currency debasement. The current price crash is an attempt to delay the inevitable flight to hard assets. The chief analyst highlights that the $78 level is a significant historical pivot point. In previous cycles, this level has acted as a springboard for a move to new all-time highs. The analyst suggests that the next phase of the silver bull market will be driven by sovereign buying. Central banks in the East have been accumulating gold at record levels, and silver is the logical next step. Nations that produce silver, like Mexico and Peru, are also looking to increase their domestic reserves. This resource nationalism is a direct response to the institutional manipulation seen in the Western markets. The chief analyst observes that the silver fraud is reaching its final stage as the physical market decouples. Once the price of a physical silver eagle reaches $150 while the paper price is $80, the game is over. The analyst explains that the banks will be forced to cover their shorts at any price to avoid a total systemic collapse. This forced buying will create the largest short squeeze in the history of the commodities market. The analyst warns that the move from $80 to $200 could happen in a matter of weeks. The chief analyst maintains that the informed investor must have their positions established before the squeeze begins. The current market crash is the final entry point for those who have been waiting on the sidelines. Wall Street is banking on the fact that you will be too afraid to buy during a period of extreme volatility. But the chief analyst reminds the audience that the best investments are made when blood is in the streets. The data on silver supply deficits and industrial demand points to a price that is many multiples higher than today. The analyst points out that the medical industry is discovering new uses for silver in advanced biotechnology. Silver has natural antimicrobial properties that make it irreplaceable in modern healthcare applications. This growing demand from high-tech and medical sectors ensures that silver will never go to zero. The chief analyst observes that the cost of mining is a natural floor that the banks cannot break for long. If the price stays below the cost of production, the mines will simply stop selling their metal. This will lead to an even more severe physical shortage and an even more violent price spike. The analyst concludes that the silver fraud by J.P. Morgan is a sign of institutional desperation. They are fighting a battle against the physical reality of the earth and the laws of economics. The silver crash is a calculated risk that the banks are taking to save their own balance sheets. But the analyst sees the end of the manipulation era approaching as the public wakes up to the fraud. The move to physical silver is a move toward financial independence and truth. The chief analyst will continue to provide deep insights into the mechanics of the precious metals market. The Watch Before Friday is a call to pay attention to the tactical moves being made by the big banks. The long-term strategy remains unchanged for the silver bull who understands the macro picture. Silver is the essential heart of the new industrial world, and its value cannot be hidden forever. The analyst maintains that the current price is a historic anomaly that will be corrected by the market. The silver fraud will eventually be remembered as the catalyst for the greatest wealth transfer in history. Investors who stay the course and focus on physical assets will be the ones who emerge victorious. The chief analyst concludes this report with a commitment to professional integrity and market transparency. The future of silver is bright, and the current crash is just a dark cloud before the dawn.